Hello again, welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is March 15th of 2022, and let's get down to our headlines, what's moving markets. Now, right away, markets are up today. We call that a relief rally. Earlier this week, we had markets depressed, right? They're continuing off of last week's sell-off, and so the Dow, S&P, and now the NASDAQ are now into closing down 20% each, respectively, any given day, and now they are down in bear market territory. Well, what does this mean, Rob? Well, ultimately, even the tech bellwethers, like the big mega tech companies, have even sold off and now are in bear market territory. On the short term, that doesn't look too good, that doesn't feel too good. But in the long term, the forward returns are very favorable once we start looking at a longer term view right now. And if you think about it, we're in the middle of the month, March 15th, and we've got about 16 days left till the end of March. That's the end of the first quarter, thank goodness, for not the best returns in terms of how markets have been treating us year to date. But what I'm saying is that there's also a strategic rebalancing that happens by institutions on Wall Street, pension funds, foundations, and endowment. That's large sums of money rebalancing. So a lot more buying coming in because stocks are down more than bonds. Believe it or not, bonds are down year to date as well as stocks, so there's really nowhere to hide. So the strategic rebalance we could see at the end of the month, and that's where we could see a bid in the market on some of these depressed indices. Now, before we get there, we have to have some certainty, and hopefully this is the moment we've all been waiting for tomorrow, and that's the Federal Reserve. They kicked off a two-day meeting today, and they're going to announce their policy changes tomorrow. We anticipate and expect a 25 basis point rise to the Fed funds rate. That just means short-term interest rates are going to rise. That's what's been forecasted, expected, and that's not what they do, but what they say on a go-forward basis. Now, if the Federal Reserve happens to come in and say, hey, we're behind the curve, it's okay for them to say with some humility that they are going to be as hawkish as they need to be, but they're going to manage the day-to-day geopolitical or even consumer concerns, or even reports that came out today, like the PMI, Purchasing Managers Index, came in hot at a 10% read. Now, what does that mean? That's where corporations and manufacturers on the front end buy the goods to put, let's say, make a vehicle, if you will. And those inputs are rising. We know the supply chain issue is an issue. We know that input costs of labor costs, wage inflation, is an issue. But this is a forward leading indicator as to what to come. So the next thing, it feeds into the consumer price index, the CPI, which this read is 7.9%. We saw that last week. But we just know that if this is 10%, this is going to rise in the future. So we have inflation on the horizon. But that being said, what's the inflation playbook? Well, you want to own assets. You want to own stocks that can grow out. We want to own, obviously, our real estate and our equity exposure is very important because you have something. Stocks are the one thing with real estate and hard assets, like even precious metals, even like I said this before, even our collectibles, from our cars to our baseball cards, they're all keeping ahead of inflation. What doesn't keep ahead of inflation is the cash in the bank. It's actually quicksand. I mean, if we're rising right now in terms of inflation rate of 7.9% or maybe even higher going forward, and our money in the bank is just sinking because the dollar, and keep in mind, the dollar traditionally rises, which we saw a strong dollar, until the first Fed cut, or Fed increase. So when we see a Fed interest rate increase, which we could see tomorrow, the next 6 months, the US dollar then starts falling. And so that's another sort of give and a get, and that could help on some other areas of the rebalancing that we discussed going forward. So just after, as we look past the Federal Reserve tomorrow, we're going to get some more clarity, listen to what they say. We could see markets sell off initially, and we could see one big downdraft, and that'll be a huge buying opportunity because the forward-looking opportunity is tremendous. There's a lot of on-sale companies right now. They're making money. Corporations are making money hand over fist, and they're even passing on those higher input costs or higher inflationary costs as we see so many corporate earnings reports. Now, once we get past the first quarter, which we will, March 31st, we'll have the reporting season, and that is in April and May. And we will be listening to corporations talk about the most important thing, which obviously how they're navigating the supply chain issues and the inflationary inputs, and obviously some geopolitical tensions that we're seeing out there. But going forward, we're going to see a lot of share buybacks. So when corporations announce in their earnings reports that they're going to start buying back shares, that's another incentive. So I think right now we've seen a lot. We've seen the markets drift down from obviously January 5th because when the Federal Reserve announced their interest rate sort of meetings and their minutes from the December meeting, we've seen the S&P down ever since, and all the other respective indices. That being said, I think we could see a reversal coming in sooner than later, and I think there's a lot of better news on the horizon. Also, once we have sort of all this negativity building up, the forward pricing of sort of PEs, price to earnings ratios, which have come down significantly, the valuations were high, really provide a great opportunity for some of the equities that we're seeing out there. So we're positioning properly, we're still being obviously balanced, and our balance is what keeps our volatility less than the respective market. And then when the time is right, we will strategically rebalance, as we usually do. And so we just sit back and wait and let the market come to us and be patient, but look at long-term investing is very important. It's what Don Stockhausen said last week on Friday. We got a lot of great reports of people tuning into Don, and Don's now back in Wisconsin. We say hello to Don. And the next time I'm here with you, I just want to point out that on this Thursday, I'm going to be with Liz Clayman on Fox Business. So the 1 o'clock closing bell, I think 12:55 our time and Pacific Standard Time, and I'll be talking about market opportunities with Liz Clayman of Fox Business. So tune in on St. Patrick's Day if you have the time. If not, you could always record it and watch it later. If not, we'll send it to you. So thanks for watching, and you guys have a great day. Take care.